In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India's top housing finance companies are moving towards affordable housing and what that really means in a falling interest rate world. And in the second story of the day, I'll talk about how a bunch of obscure sounding metals quietly became one of the world's biggest geopolitical weapons. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 12th of May. In the first story of the day, let's talk about the latest quarterly results of housing finance companies in India. See, in the previous quarter of FY 2025, four of the biggest players in this particular space, which is Bajaj Housing Finance, PNB Housing Finance, Aavas Financiers, and Aadhar Housing Finance, posted fairly strong results. Now, at the face of it, that's definitely great news. But if you look a little bit more closely, you'll start to spot clear shifts in the air. And one of that shift could really reshape this entire sector in the coming few years. I'll explain. See, these companies may differ in size, scale, and strategy, but there is one theme that all of them seem to agree on, which is that affordable housing is becoming the new battleground for them. Now, mind you, this is not because it's trending or everybody's suddenly interested in it, but it's actually because it might be the smartest way to grow in a market where margins are under pressure and interest rates are sort of headed downward. If that sounds confusing, don't worry, I'll break it down. See, when a company like Bajaj Housing Finance or Aavas Financiers gives you a home loan, they make money on the spread, which is basically the difference that they earn on your loan and what it costs them to borrow that money from the market. But with interest rates trending downwards, that spread is starting to get squeezed a little bit. Basically, loans are getting cheaper faster than capital is, and that is exactly where things get a little bit tricky. Because when your yields start to fall faster than your borrowing costs, your profitability suddenly starts to shrink. And while this does not necessarily mean losses as such, what it does mean definitely is thinner margins. And that is why housing finance companies are now looking for places where they can still earn slightly higher returns, and affordable housing offers one of those very rare opportunities. Let's take a look at how each of these companies is actually adopting to this new particular landscape, starting with the one that is clearly leading the entire game, which is Bajaj Housing Finance. Bajaj's assets under management grew 26% year over year, and they now stand at about 1,14,000 crore rupees. They operate across prime housing loans, affordable segments, lease rental discounting, and even developer financing. It's sort of like a spread out play which allows them to grow across different verticals without really relying too heavily on any one single segment. Now, what stood out specifically in their recent earnings call was the management's clarity about their future. They said, and I quote, "The company has strengthened its management team and will invest deeply in strategic business units and non-metro markets in FY 2026 to ensure sustained growth." Now, that, mind you, is a fairly strong signal that they are not just growing, but are actually gearing up for even bigger bets in the future, especially in smaller cities, even while the market braces for a softer interest rate environment. Anyway, then there is PNB Housing Finance, which has had a major comeback in the recent times. Its retail assets rose by 18% year over year to about 75,000 crore rupees. But the real story here lies in the affordable housing segment once again. The business has shot up 183% compared to last year and is now touching 5,070 crore rupees. Now that, mind you, at this point is not really a small side bet. It is absolutely a full pivot in many ways. Their MD said, and I quote, "FY 2026 is going to be far better than FY 2025 for the industry. By March 2027, our retail loan book will hit 1 lakh crore rupees, with affordable housing at 15,000 crore rupees and emerging markets contributing 25,000 crore rupees." In short, they're basically placing their bets on two main areas, which is affordable loans and expansion into newer and possibly underserved regions. Anyway, moving on, let's talk about Aavas Financials. See, in contrast, they are taking a slightly more conservative stance. Their AUM grew by 18% and reached about 2 lakh crore rupees. The standout move was their expansion on the ground, which is that they opened 30 new branches in the last year, which took their total to 397. But while they're expanding, they aren't chasing growth blindly as such. Their managing director Sachin Bhinder made it very clear when he said, and I quote, "We remain cautiously optimistic, aiming to sustain our growth around 20% of AUM." So basically, rather than swinging for the fences in some sense, Aavas is actually sticking to a steady measured pace. Moving on, Aadhar Housing Finance, which is the smallest among the four in terms terms of book size also showed fairly solid numbers here. Their AUM reached around 25,500 crore rupees, and what is interesting is their diversification strategy. They've actually ensured that no one state contributes more than 14% to their loan book, and that's pretty clever because it reduces their concentration risk to quite a great degree. They have also entered new markets like Himachal Pradesh and Assam, which basically suggests that they are looking to widen their reach through newer geographies rather than just deepening the existing ones. Now, moving on, let's look at how these companies are actually managing the quality of their loan books. Because the thing is, in housing finance, growth is only as good as the repayments that you get. See, Bajaj Housing Finance is clearly at the top here. Their gross NPAs or non-performing assets are just at 0.29%, and their net NPAs are even lower at about 0.11%. But what makes their performance even more interesting is their approach to risk in general. See, despite having industry-leading asset quality, they have gone ahead and increased their provisioning coverage ratio to 60.25%, which is up from 55.44% in the previous quarter. Now, what this means is that they're keeping aside more money from their profits in order to cushion against potential loan defaults. It's almost like setting up a safety net when the risk already seems low, and that, mind you, speaks volume about what their risk appetite looks like. Anyway, Aadhar Housing Finance is doing well too, despite a riskier customer base in general. Their gross NPA is just 0.21%, even though they focus heavily on the lower income segments. Now, that goes against conventional wisdom in many ways, which says that lower income borrowers are more likely to default. But Aadhar's performance actually suggests a little bit of the opposite. They seem to have strong underwriting and efficient recovery processes. Moving on, PNB Housing has been working very hard to clean up its book as well. Their gross NPA has improved to 1.08%, up from 1.5% just about 1 year ago. And this big boost came from recovery efforts where they managed to recover 336 crore rupees from previously written off accounts. Now that is a 236% jump compared to last year, and clearly they're getting better at dealing with past delinquencies. Aavas though saw a very slight uptick in their gross NPA from 0.94% to 1.08%. Now on its own, this increase is not really alarming as such, but if you dig just a little bit deeper, you'll find a subtle red flag here. Their 1 plus DPD ratio, which basically measures the percentage of borrowers who have missed at least one EMI, was at about 3.39%. Now, these are not NPAs yet, mind you, but they are definitely early warning signs. Every bad loan begins with a missed repayment, and that's exactly what may be happening here. But the good news is that Aavas' 1 plus DPD ratio has actually been falling for the past few months and is roughly flat compared to last year. So while there is definitely some sort of stress, their collection systems are doing their job for now. So all of this now brings me to the biggest challenge that these companies are facing, which is keeping their profitability intact when interest rates are actually falling. Remember, most home loans are tied to the repo rate, and when the repo rate falls, the loan rates also fall, and very quickly so. But for housing finance companies, their cost of borrowing does not fall at the exact same pace, and that is because they have already borrowed funds earlier at higher rates. So while their income from loans drop, their own interest expenses do not reduce as quickly, and this squeezes their spreads. Aavas financials felt this pressure in quarter 4 because their spread shrank slightly to 4.89% from 5% in the previous quarter. And that is pretty significant because this is the first time in the last 8 years that their spread has actually dropped below 5%. Their CFO admitted this during their earnings call and said, and I quote, "In a falling interest rate scenario, there will be some negative impact on spreads, but historically, we've found ways to protect our margins effectively." PNB Housing, on the other hand, seemed fairly more optimistic. Their management believes that by focusing more on high-margin segments like affordable housing and corporate lending, they will be able to hold on to their net interest margins, aiming to keep it stable at around 3.6 to 3.65%. Bajaj Housing also saw a fair bit of a dip, and their gross spreads fell to 1.8% from 1.9% in the previous quarter. Now, this is not quite a one-off issue, and it reflects a growing competitive pressure in general. And that's because as most lenders compete for the same set of borrowers, it is very natural that yields will get pushed down. And this pressure, mind you, is not limited to only housing finance companies. CareEdge Ratings recently said that banks too have reported their lowest NIMs in the last 8 quarters. Now, this squeeze is fairly widespread. Add to that some recent regulatory changes and the rising competition for deposits, and it is fairly very clear that NIMs across the board are likely to remain under pressure. And that is why so much of the future now rests on affordable housing. PNB Housing is already going all in on this. Affordable loans made up 40% of their retail disbursements last quarter. Valli Sekhar, who heads their sales and collections for this segment, pointed out that they closed the year with a loan book of 5,070 crore rupees, which is a 183% jump from last year. Bajaj Housing as well has started a new business unit dedicated to near prime and affordable housing customers. And according to them, this unit is already delivering results exactly as planned. For Aavas and Aadhar, this is not a new game like you may have figured, because it has been their core strategy right from the very beginning. Over 84% of Aavas's loans are below 15 lakh rupees. And for Aadhar, 66% of their book is made of loans to economically weaker sections and low income groups. Now you might wonder, won't the big players like Bajaj and PNB eat into the market share of these smaller affordable focus players? Now that is a very fair question. But here is the thing, the affordable housing finance market is still severely underpenetrated. There is more demand than supply is. And because this business is deeply local, lenders tend to focus on specific towns and districts where they know the customer and repayment behavior very well. And there is actually room for everyone to sort of grow without stepping onto each other's toes. But there are still few signs that call for caution here. Aavas financiers flagged rising delinquencies in unsecured microfinance loans, and they warned that customers are becoming more over-leveraged in many ways. In other words, people are borrowing more than they can realistically repay, and that could sort of spill over into other loan segments, and that is why Aavas has tightened its lending standards. Their loan approval rate has dropped from around 42% a year ago to 38% now. PNB Housing saw its operating expenses go up by 19.4% year over year, which is a sharp rise and could start affecting profitability if it is not brought under control. Even Bajaj Housing's yield dipped slightly to 9.7%, down by 10 basis points. Now again, this is not massive, but it is a sign that competitive pressure might continue to squeeze them. So the question then is, where does all of this leave us and what is it for us to take away from here? See, India's housing finance story is still a definite growth story. There is a massive need for home loans, especially in smaller towns and lower income segments. Government initiatives like PMAY 2.0 add only more fuel to this growth. But at the very same time, falling interest rates, rising competition, and signs of borrower stress also point to a more complicated future in general. But as Aavas puts it, FY 2026 is going to be far better than FY 2025 for the industry. Now that may well be true, but always the devil lies in the details. On that note, let's move on to the second story of the day and talk about rare earth elements. See, imagine you wake up one day and you realize that your phone did not ring, your fan did not spin, and even your Wi-Fi router was dead. You go and try to make breakfast, but your induction stove does not turn on. You go and find the TV remote, but nothing happens and the TV does not turn on. The screen stays blank. It basically feels like the world has sort of come to a standstill, and it sounds extreme and almost dystopian to many levels. And maybe some of you may think that I've gone crazy to even say this, but honestly speaking, this is what life could look like without rare earth elements. And while these rare earth elements are not going anywhere overnight, the problem is that they are becoming harder to access. There is a very big brewing geopolitical battle that is very quietly turning these obscure metals into one of the most important and dangerous supply chain bottlenecks of our time. So today in this story, let me break down what these rare earth elements are, why they matter so much, and how the world has let China gain a near monopoly over them. To begin with, the term rare earth refers to a set of 17 metallic elements. 15 of these sit together on the periodic table under a category called lanthanides, and the other two are not technically lanthanides, but they behave similarly in chemical reactions, so they are also grouped under the same label. Now the thing is, despite what the name actually suggests, rare earths are not actually rare in many ways. Cerium, for instance, is roughly as abundant as copper in the Earth's crust, and even the scarcest of these elements are actually hundreds of times more common than precious metals like gold. The name rare earths is actually a historical accident. The thing is, in the 1700s, some scientists discovered strange minerals in unusual looking rocks near the Swedish village called Ytterby. Now these were oxide based materials, which is what people at the time generally referred to as earths. And because these minerals came from rare rocks and they looked a little bit different from the usual stuff, they were called rare earths. And the name sort of stuck along, and it's a bit misleading to be honest. But anyway, that aside, the real challenge with rare earths is not that they are hard to find, it is that they are way too spread out. Unlike metals like iron or copper, which form rich concentrated deposits, rare earths are actually scattered across various kind of rocks in very tiny amounts. And when you do find usable deposits, you are likely to find many of these rare earths tangled together, and that is because they are chemically so similar that it is extremely difficult to separate one from another. And this separation process is very messy, it is expensive, and also very slow. do. It basically takes hundreds of chemical steps, uses a lot of acid and industrial solvents, and also produces massive amounts of waste, some of which can also be radioactive in nature. And that, mind you, is what makes rare earths such a pain to extract and to refine. It's not really a geological problem in many ways, it's actually economic and a technological one. So the question then is, what makes it all worth the trouble for everyone? See, rare earths have some very unusual and also very useful physical properties that make them essential for modern technology. The most important of this is magnetism. See, magnets made from neodymium, iron, and boron are the strongest permanent magnets that we have ever made as humans. They are about 10 times stronger than regular magnets while also being much smaller and much lighter. And today, magnets are everywhere in speakers, in hard drives, electric vehicle motors, industrial generators, and also wind turbines. Rare earth magnets are the reason why these devices can be so small yet so powerful. Now, some rare earths also have a very unique optical property. Europium and terbium, for instance, help produce the red and green colors that you see on your phone and TV screen. These elements are usually hosted in a crystal structure which is built from yttrium, and without them, our screens would look much bulkier, much less colorful, and also far less sharp than they currently do. Other rare earths also have some catalytic powers. They help accelerate chemical reactions, and that makes them critical in oil refining and also in the catalytic converters inside vehicles, which basically help reduce the harmful emissions from exhaust systems. And that entire comprehensive list that I just gave you is only a very quick sample. In reality, rare earths are actually hidden inside everything, right from lasers and MRI machines to even defense radars and satellite systems. But there are two specific use cases that make rare earths very, very irreplaceable, which is clean energy and also military applications. Let me start with defense. See, modern defense equipment is deeply reliant on rare earths. Fighter jets use rare earth magnets for their electronic systems, rare earth oxides in their screens and displays, rare earth alloys in their engines, and also rare earth coatings for stealth. An F-35 fighter jet, for example, contains nearly half a ton of rare earth materials, which is roughly 3% of its total weight. Now let's shift to the world of clean energy. See, whenever you want to convert motion into electricity or vice versa, you need magnets. Wind turbines use them to generate electricity from winds, and electric vehicles use them to turn electricity into motion. Now, one wind turbine alone can contain up to a ton of rare earths. Electric vehicles use a few kilos each, and that is why rare earths are very crucial to the green transition for the entire world. Basically, without them, the clean energy movement slows down drastically, maybe to some extent even become close to impossible for us. And that is why, as you would expect, the demand for them is absolutely surging. The International Energy Agency projects that rare earth demand will rise anywhere from 3 to 7 times by 2040. One analysis estimates that for every 1% increase in green energy deployment, global rare earth reserves shrink by 0.18%. Now, that is an incredibly steep cost to pay for the transition, but is also unavoidable with the current technology that we have. And that brings me to the real reason why rare earths are suddenly in global spotlight, which is control. See, even though these elements are found across the world, like I mentioned, the mining, processing, and manufacturing are almost entirely controlled by one single country, which is China. Right now, China mines about 70% of all the rare earths available globally. It processes between 85 to 90% of them, and it also dominates manufacturing. For example, it produces over 90% of the world's rare earth magnets. Now, this, mind you, did not happen by chance. Back in the 1970s and the 1980s, while the world was focusing on oil and semiconductors, China was quietly starting to build out its rare earth supply chain. Deng Xiaoping, who's the Chinese leader at that time, understood their strategic value long before anyone else did. He very famously said, and I quote, "The Middle East has oil, China has rare earths." At that time, the US was the world leader in rare earths and produced most of the supply from the Mountain Pass mine in California. Now, these materials were very critical to the Cold War era defense race, and the US even invented samarium cobalt magnets in the 1960s for radar and missile systems. But China played the long game over here. Between 1978 and 1995, they ramped up rare earth production by nearly 40% every single year. They flooded the global market with cheap supply and they undercut US producers. Now, this was not just because of cheap labor. China also invested in separation technologies. They built an end-to-end domestic supply chain and also accepted far higher levels of environmental damage than most other countries were willing to tolerate. And over time, Western production lost out to it. By the early 2000s, China controlled nearly 98% of global rare earth production. And even today, most countries have found it almost impossible to catch up to them. The barriers to entry are very, very steep here because once a rare earth deposit is even discovered, it can take as much as 7 to 15 years in order to develop it. A separation facility can cost upwards $1 billion, and the technical expertise that is needed to refine these elements at scale is still very, very concentrated only and only in China. Now, there is also an environmental cost to all of this. For every ton of rare earths that you refine, the process generates roughly 2,000 tons of mining waste, which includes radioactive slurry and acid-rich byproducts. China has already destroyed entire water bodies and farmlands near its mines for this, and most countries today are unwilling to pay that price. But this is also what makes China's grip over rare earths so very dangerous, because it gives China the power to choke off the supply at any point in time it wants, and it has already done that before. In 2010, after a diplomatic clash against Japan over the Senkaku Islands, China very quietly restricted rare earth exports to Japan. They didn't issue a formal ban as such, they just slowed down shipments drastically. Prices, of course, skyrocketed as a result. Neodymium shot up by 575%. Dysprosium, which is another rare earth, went from $250 per kg to $1,500 per kg. Japanese manufacturers, especially in auto and electronics fields, were completely caught off guard for this. But Japan eventually had to fight back. They built a 5-point strategy to cut usage and diversify supply. Over the next decade or so, they brought down their dependence on Chinese rare earths from 90% to 60%. But the message was very clear that rare earth could be used as a weapon. And China, mind you, has not stopped since then. In April 2025, which is very recently, in retaliation to American tariffs, they imposed fresh export restrictions on 7 rare earth elements. Now, these are particularly important for defense and high-performance magnets, and the signal here was unmistakable. China is ready to use rare earths for geopolitical pressure across the world. Now, this is a part of a broader trend that analysts are calling as weaponized interdependence. See, as global trade now becomes more adversarial, countries are now using their control over key supply chain nodes like semiconductors, batteries, or rare earths as tools of strategic power. Basically, whoever controls the choke point here controls the leverage as well. And that is what's worrying governments worldwide. The US, for example, has started pumping millions of dollars into building rare earth capacity. India has also launched a national critical mineral mission and has opened up rare earth mining to private players for the first time ever. We are also partnering with countries like Australia and even manufacturing small batches of magnets at BARC. But this, like I said, is a decades-long project. What's interesting though is that India has around 6.9 million metric tons of rare earth reserves, which is roughly 5 to 6% of the global total. But the problem is that we produce less than 1% of the supply right now. And that is partly because our deposits often sit alongside thorium, which is treated as a nuclear fuel and falls under tight regulations. For decades, a single government entity, which is IREL, was allowed to mine these resources, and that sort of limited our ability to build a full-fledged ecosystem. But like I said, the policy is slowly starting to shift now, but the only problem is that it'll take some time. And in the meantime, the risks remain very real. If China were to hypothetically halt exports today, the impact would be immediate and very, very severe. EV production could drop by as much as 25%, wind turbine manufacturing could drop by 90%, and production of fighter jets could grind to a halt completely. Even MRI machines could sort of disappear from hospitals for many months at a stretch. Eventually, of course, the world will manage to adapt. As Japan's example shows, it is possible to de-risk from China, but that of course requires a long-term plan, deep investments, and hard trade-offs. Currently speaking, many countries are simply not prepared for it. And that brings me to the end of the 2 stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, Coal India has announced plans to set up 4.5 gigawatt of renewable energy capacity at a cost of 25,000 crore rupees to supply carbon-free power to AM Green's green ammonia facilities in Gujarat's Kandla or other locations. The project will combine 2,500 to 3,000 megawatts of solar and 1,500 to 2,000 megawatts of wind capacity, with wind projects likely in southern states and solar plants in Gujarat and Rajasthan. Second, Larsen & Toubro or L&T reported a 25% year-over-year rise in consolidated net profit to 5,497 crore rupees for Q4 of FY 2025, supported by a 10.9% growth in revenue to 74,392 crore rupees. Third and the final one for the day, billionaire Sunil Bharti Mittal, who's the founder of Bharti Airtel, is in advanced discussions to acquire a 49% stake valued at $2 billion in the Indian arm of Chinese appliance giant Haier, according to Bloomberg. Mittal has partnered with private equity firm Warburg Pincus for the deal, which could be finalized in the coming few weeks. By the way, Hire's Indian unit currently operates 3 manufacturing plants producing air conditioners, refrigerators, washing machines, and other appliances. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.